Okay, welcome everyone to MacroAce's trade prep for EIA Inventories with your host Tony. I saw a comment from Theodosios Constantelius saying, "Love those streams. FJ team rocks. Thank you very much." I presume you're talking about the previous stream that we did for retail sales and Canadian CPI. But yes, thank you for joining. Thank you for those comments there. Yeah, so hopefully everyone's doing fine after that aftermath of some slightly worse than expected data for retail sales, but which was worse than the prior figure. We'd seen the S&P 500 see them move towards the downside off of those worse than expected figures from retail sales. Other than that, how is everyone doing so far? Are we all good? Can we see my screen all right? How are we looking? Okay, so EIA Inventories, we've got about 3 minutes until we until we start the presentation. Just want to kind of see who's jumped on, if anyone has jumped on here. If anyone's going to trade the inventories data. Okay, so I think we're going to start a little earlier with EIA Inventories. We've got some sentiment to go through as well, which has been quite choppy in the last week or so, particularly today as well. So let's go through the presentation now. Okay, so EIA Inventories. So what is it? It represents weekly change in crude, gas, and distillate inventories. Transportation is affected the most with this, and it also affects consumer prices for a number of products. Go on to the next bit. So it can be a very volatile trade with the crude oil inventories data and the EIA inventories data overall, where we can see some big swings in the crude market from the data, and we'll go through the deviations and some of the market reactions that we had seen before with the crude oil inventories data or the EIA inventories data that had come out previously. So how does it affect the markets? Well, the key thing to note, if there's more oil added or if there's a build in inventories, that's negative for oil prices. Of course, if more is being produced, then that would mean that the demand, then that would lead to, so if the more oil is being produced, that will lead to lower prices because there is less demand for it. If less oil is added or if there's a draw, then that's positive for oil, as the demand is, if demand is increased, but so if there's less oil being created, that means, and there's more demand for it, then that would cause the rise in crude oil prices. So that's how it affects the market. How it affects the markets. There's nothing too different about it. Sentiment or what it means for the markets doesn't really affect the basic effects of the market reactions. The only thing would be if we get anything like the Russia-Ukraine situation escalating or de-escalating. We'll go through that in a bit. Then that's where the story changes and it becomes more interesting. So if we look at the next point, so triggers then for the release, if I bring up here, so the high estimate we see of 2 million with a low estimate of minus 1.47 million. As for the crude oil inventories data, for the gasoline inventories data, the highest estimate at 1.6 million with a low estimate of minus 3.5, and distilled with a high estimate of 1.3 million and a low of minus 3 million. A reminder as well with the API data we had that had come out last night, the forecast was for a draw from the prior figure of 2.811 million. So a reminder, the API data is private data that isn't released out to the public. So getting hands on that is a little bit can be difficult for traders. But what we had seen but what it can do is it can potentially lead to expectations of what to expect for the following day for crude or for inventories data, and whether if the private data is if it does show that there's a build, then potentially it could mean that the data the following day could show a build as well. But that's not always happened. That's not always been so clear. In the past with the API crude data, where there hasn't been a situation or hasn't been an escalation of war, or if there hasn't been a war situation where the markets are in a normal situation, then you would see stronger moves from the API data the night before. But as said, API is kind of a way to kind of gauge what to expect for the following day ahead, but doesn't always marry up with the data that comes out the following day. So the actual data from the forecast of a draw came in at a build of 3.754 million barrels for their week being added according to private data. So off the back of that, we did see some weakening on crude oil inventories. Excuse me, on WTI crude oil. I'll just bring that up here. We can go back to last night. Okay. Okay. So the data being released around there, around 4:30, did see some movement towards the downside on WTI of that bigger build we had coming through for API. Now, as I said, does that mean that we're going to have the same reaction for today? Or does that mean we get the same figure or similar figure for today for a build in inventories? That's not always the case, but just from the reaction that we've seen last night, some traders do take that as a way to kind of gauge what to expect for the day ahead. But there, API data being released and then it coming out and seeing some movements towards the downside on WTI off of that larger than expected build from the API data. So just to bear that in mind, if you do trade the API data, or if you're not sure of what the API data means and what it can do. Going back to the report then, back to the presentation. So the market reactions, if we have a little look at what we had seen in the past, let's go to micro futures, crude. Okay. And then if we go to March 9th, so last week's data, got 1029. So about 10 seconds before the release, we'll have let's see what the market had done, or what crude oil had done. So what we'll note is that we had seen a movement towards the upside on crude inventories, even though we may have seen. So here we go. Here's the deviation from the actual figure from the median forecast. Okay, so 30, and we see the movement towards the upside. Again, data came in at as a draw on the forecast figure at minus 1.863 million. There was about a 0.613 million deviation from the forecast figure and the actual figure. And from there, what we'll notice is that the initial move towards the upside had seen about 81 ticks up on WTI crude oil off of that draw on the forecast figure for crude oil inventories. But what we'll notice is that the reaction kind of, see here, so it's not as strong, or it doesn't hold its movement towards the upside. And we'll also look at the March 2nd data as well as an indicator of how strong of a movement we could expect. But as we can see here, so the figure, although there was a draw and it was better than expected for crude oil, or WTI crude oil, did see that move towards the upside. It wasn't as strong of a movement, or didn't sustain that movement too much. So if we go further ahead, let's go about 5 minutes ahead, see what we had. So again, after about 5 minutes, that data had erased its initial move towards the upside after about 5 minutes, and then we'd seen the continuation of how the markets, going in their normal direction, or resuming their normal direction. So that's one thing to bear in mind, is that with this data, you didn't see a strong deviation of what, as said, what we were looking for the deviation from the prior release. We were looking for about 5 million deviation to see a good strong reaction to be held, but that didn't. But even on that, for March 9th, that didn't occur. Well, we didn't get that deviation, so hence we got this 81 tick up, and then a quick reversal of that initial move towards the upside. We go to March the 2nd, where we did get that 5 million deviation. Hopefully, does everyone understand when I talk about deviations and on what that means? Just kind of clarify that. So the deviation is the forecast figure minus the median figure, and whatever the difference is, that's the total difference or deviation for the figures. And it's a good way to kind of gauge, okay, what kind of market reaction could we expect? How strong could that market reaction be? And that's why we've noted it down on our side here. So if I go back, let's go to March 2nd, so the week before that. Let me know if this if this doesn't make sense, and I can kind of go over some stuff. Okay, so here we go. So March 2nd. Let's play the data. Wellington Prado says, from your experience, do you believe that oil inventories will continue to be under pressure in the short term? And do you believe the price will stay above 100 for some time? So this is the current scenario that we face with Ukraine and Russia situation. That with oil prices at the moment, we can see there's a huge chop and change, where we'll go through the sentiment as well, where if we get positive news coming out from the Russia-Ukraine conflict, where they're looking to de-escalate the conflict, then you'd see, as we had seen from history, you'd see a decline in WTI crude oil prices. Whereas on the flip side, if you do get positive news, which, we're getting, as I said, we're getting a mix of positive and negative news. When we get positive news, when we get negative news, we see WTI appreciating, and when we see positive news from the Ukraine-Russia conflict for the market overall, then we see WTI seeing some movement towards the downside. So because of that mix and chop and change, and there being no real clear direction from these negotiations that we see so far, it's going to be quite choppy from what I've seen, and from what we've seen at Financial News so far. That sentiment, so the sentiment will just flip from risk on to risk off very, very quickly. So that's quite hard to gauge at the moment. So in the short term, yes, there is pressure in the oil markets facing the current whipsawing left, right, and center for crude oil, for oil at the moment. Not only just oil, but I think commodities in general. So you've had the wheat market where that had seen huge move towards the upside, and where that had also come under pressure. The metal side with nickel had also come under pressure as well from the Ukraine conflict. So overall, commodities, and particularly in oil inventories, I think if we're talking about for the demand overall, which we'll kind of go through and have a look. Hello, Omar. Hello. How you doing? You okay? But yes, I think for oil inventories overall, globally, I think that there is going to be pressure if you have one company's banning investment, or banning buying from Russian companies, and Russia being quite a large provider of energy, particularly to, let's say, to the European Union, where the liquid natural gas they provide makes up about 46% of the Eurozone, of the EU's energy consumption, liquid natural gas consumption. So off of the back of that, yes, it could cause further pressure in the markets, where we do see these strong moves occurring in the markets. Does that make sense? I know I kind of went a little bit of tangent there, but all you've got to know is current Ukraine-Russia conflict has created short-term pressure for the oil market, with the constant changing, and also the bans and sanctions placed on Russia. So yes, there is some pressure coming into the short term. Long term, again, about prices, again, that's more of what sentiment is for the day. So that's harder to kind of predict whether that, or say where that will go. Okay, let's go to where else we're looking. So back to the presentation. So I want to go through that sentiment now with you, but I want to finish off looking at this, what we had seen from the prior release. So the March 2nd, where are we? Okay, so if we keep an eye here, so this is on March the 2nd, of where we had the figure coming in. It wasn't too much of a deviation really here, although there was a slight draw. Excuse me, there was a huge deviation. It's about 5 million. Excuse me, correction on that there. Just seeing some Dixie weakening, just going back to what we can see in the markets now, before the crude oil inventories data. What news do we have coming out? What do we have? There was something that must have come out here. Oh, wow, okay. Okay, so here we go. So we've had some news about a minute ago, just to make you all aware. This is probably going to affect how the markets, or how crude, or WTI crude reacts. You've had, according to the FT, that Ukraine and Russia have made significant progress on tentative 15 points peace plan, including a ceasefire and Russian withdrawal. If Kyiv declares neutrality and accepts limits on armed forces. It's according to the FT. So S&P seeing some risk on reaction here, although some of this news had come out beforehand. from the Kremlin side being put out the from the FT, gaining some traction there, or further traction, shall we say, and more of a stronger reaction so far. So I guess sentiment overall now, if we're sticking to it, well, like I said, chop and change. Any bit of positive news. Look, Dixie. So WTI crude oil is down by, WTI crude oil is still up by about 1.4%, but did see it move down off of that. Dixie now down a 0.6%. S&P up nearly 2% or 1.9%. So risk on reaction. So crude oil is not liking that at all. I was going to go through some other bits of sentiment, but I think I will still go through it for historical reference and what else to expect. But I think that bit of news might just take over the crude oil inventories data that we get today. We had seen it in the past where if there had been big news just on that day, that the inventories data didn't see too much of a reaction. But I think with news like this, and with a stronger move like this, it's going to be hard to predict whether we do get a reaction or not today. But let's go back to the sentiment and continue with that. So sentiment. Is everyone kind of okay so far? I'm very conscious and aware that some of you might be trying to trade that, might be trading that, or you might not be, or if you're just kind of listening in. I'm listening to my voice and watching the presentation while pandemonium is occurring in the markets again. If not, then fine. That's okay. So, sentiment. Lots of sentiment that is affecting WTI, and why we're seeing huge moves in crude oil prices in general. So one, you've had Libya today, Libya's prime minister saying that they have plans to enable national oil company to increase production in short term and medium term. Again, the more oil you produce, the cheaper or the less demand, and then oil prices to go down off of the back of that. And then just also in general, oil prices, as I've already said, have seen wild swings in the last month, with a rally, with it rallying to a peak of $130 a barrel last week, before falling to around $100. And now, as we had seen, that's below that 100 at the moment on WTI crude oil. So Russia, CNN citing the IEA report that we had recently. So they had mentioned that the world's second largest crude oil exporter could be forced to limit output by 3 million barrels per day in April. And the IEA, or the International Energy Agency, warned on Wednesday, as major oil companies, trading houses, shipping companies shun its exports and demand in Russia slumps. So as I was saying, Wellington, the banning of trading with these Russian energy companies is causing these huge swings where you've got countries looking to other nations, such as the UK, which had discussions with the United Arab Emirates, and where they're also looking for oil from the Saudis too. But today they're having their discussions with the United Arab Emirates. No indication of whether those talks have gone well, but there is a demand for other oil off of the back of cutting, or looking to cut off demand from Russia altogether, or not altogether, but to decrease that. You've also got to bear in mind the European Union, they can't really cut off their energy supply from Russia. Like I said, their liquid natural gas supply for 2021 was 46%. So if you remove that altogether for the European Union, that causes huge disruptions where you would see liquid natural gas prices soaring because of the drop in supply from Russia, or the withdrawal of that 46% in supply from Russia would have huge implications for that there. So also to add as well, for the oil markets facing the biggest supply crisis in decades, unless OPEC boosts output, according to the IEA. It's again from their report earlier on. So again, if there's been no discussion from OPEC so far as of that as of what they could do to kind of limit the fallout from this whipsawing that we're seeing in the markets. So remember, you had OPEC yesterday providing their thoughts on the Russia-Ukraine situation, where they said yesterday that due to the unclear and rapidly changing situation in Ukraine, OPEC has decided not to revise its predictions for 2022, saying that the short-term impact of the Ukraine crisis and ongoing concerns about COVID on economic growth will clearly be negative, and the global growth prediction for 2022 remains unchanged for the time being. So they've maintained if OPEC were to jump in and pump more oil into the markets at this point, it would cause a lot of, increased volatility if OPEC, the guys who control the supply of oil, mainly globally, then you would see, as I said, an increase in volatility where you would see crude oil prices seeing a move towards the downside, and where we can also see from. So again, OPEC kind of at the moment has its hands tied with what to do. It's more of a wait and see situation for them. Then the next point. So other than Libya, the Russia-Ukraine conflict, and the recent headlines that we've seen whilst I've been streaming this here, so you've got Iran with their point, so that Russia softens Iran demands, and reopening way for nuclear deal. Russia walked back recently, made demands in Washington related to Iran nuclear deal, clearing the way for Tehran and Washington to revive the 2015 agreement, according to senior diplomats had made those comments. So because of now that there's, as I said before, finalization of the Iran nuclear deal that is about to occur, and when that does happen, reminder, Iran has said in the past that they can jump into the markets and start pumping oil. Now, if you're a conspiracy theorist, I don't usually like that sort of stuff, but some people are saying that with Iran, with Russia, with issues with Russia affecting the energy markets, that the US is looking to Iran. But to be fair, Russia had only supplied about 3% of the US's, or about 6% of the US's energy to them, particularly in crude or in oil. So 6%, yeah, that's a significant amount. But with Iran, if people are thinking that they're going to be able to revive or complete that or fill up that gap, then that's a very, very far cry. That doesn't look so probable, with considering how quickly Iran would have to, and how much Iran would have to pump oil back into the markets to make up that loss of supply. So I don't agree with that sentiment there, or that, not sentiment, I don't agree with that conspiracy theory that the US is open to the Iran nuclear deal occurring. There's been talks of that for ages, and it's just been a chop and change of whether the deal is going to be finalized or not for a very long time. Going back to, so from Bloomberg Economics, they provided a nice little chart here of oil watch. So supply, a bigger drive of oil prices than demand. So the issue with supply is that if there's a loss of supply to the oil markets, then that would raise crude oil prices. But if there are positive discussions happening between Ukraine and Russia, then the energy market would start to settle down, and then crude oil prices will start to settle down in volatility as well, where we don't see $35 moves in a month from WTI crude oil. So this is what it's showing here. So you've got the purple showing the change in oil prices in demand. So if we look at March, so the demand here, change in oil prices hasn't really been that big compared to what we'd seen during the pandemic. The change in oil prices due to supply, yeah, heck yeah. with the loss of some of that supply, or the uncertainty surrounding whether Russia or the energy market can hold itself up without with a war going on, that has increased significantly. And so the overall, and then it shows the overall change in oil prices, right? So we can see, so US dollars per barrel, so back there, 50, and then see around here. So again, a small decline. Excuse me. So we had seen a huge increase by about $50. Excuse me, or to their index, or US dollars per barrel, about 50 or near enough $50 per barrel. What we'd seen in towards the middle of February, and now we're seeing that decline as the de-escalation occurs between Russia and Ukraine. So, oil, what do we do today? So, well, with this positive news that we've had today, it seems like it's kind of settled off at the moment. We've got about 2 minutes, so let's go back to our chart. Let's go back to our live feed. Okay, let's see. Right, looking at our here, we've got about a minute left, less than a minute. Let me bring that up again, actually, because that's not moving. It's not moving in real time. That's what we wanted. Okay, there we go. It's better. Okay, can everyone see my screen clearly? So again, just to make it clear, deviation of what we're expecting of, if I bring it up, the deviation of at least, I think, so we're looking for about at least 3 million for a strong reaction, or some sort of, if we do get smaller reaction or smaller deviation of about 1 million, then we are towards the upside. Excuse me, if we go about 10 seconds. So if we see deviation to where we see a draw, then that'll be positive in the short term. Okay, a couple of seconds. Oh, there we go. Okay, all right. So that's a build of 4.345 million. That's a build there off of the forecast of minus 1.8 million. Okay, let's keep our eyes peeled. Gasoline inventory seeing a draw of minus 3.616 million compared to the forecast of minus 1.462 million, and distillate seeing a build of 0.332 million. Okay. Crude oil has not reacted, really. I mean, we did see something, a bit of a move towards the downside, but again, I think that positive news from the FT is just it's just taken over the sentiment here. Again, okay, so tick wise, let's see. Virtually, whoops, unchanged. Okay, we did see 42 ticks towards the downside off of the back of that release there for crude oil inventories. Again, not really. Again, I think it's more so the headline that we just received from the FT, where Ukraine and Russia have made significant progress on a tentative 15-point peace plan, including ceasefire and Russian withdrawal if Kyiv declares neutrality and accepts limits on its armed forces. So I think with the extra supply that's come in to the markets, or the build in supply that's coming to the markets, and also the positive news of the de-escalation of Ukraine and Russia, we're seeing a continuation of movement towards the downside, but the release itself didn't really see that much of a reaction. So again, there's about 42 ticks towards the downside, what we had seen there. So if I just pop that in. Okay, I'll have a look at the deviation as well. Median survey. Oops. It's 1.8 and was 4.345. Wow, okay. Right. So, just on the crude oil inventories data, we had a 6 million deviation from the forecast figure to the actual figure. So that's a huge deviation. But the markets didn't, but the release itself didn't cause that much of a reaction. So as kind of says, so the sentiment of what we've had in the past, as I said before, if there's positive news that come out or negative news that can and has, from what we've seen, had an effect on whether the release doesn't matter. I think this has been quite interesting here, where we did get something, but not as strong. Now the markets are continuing their move of what they had seen beforehand from that positive news from the FT. Okay, so I guess that can kind of concludes the crude oil inventories, or the EIA inventories trade prep. Was anyone planning to trade on that data beforehand, before we had that FT news coming out? Omar or Wellington or Theodosios Konstantelos? Was anyone planning to trade that release, or were you gonna kind of leave it untouched, or what were you guys thinking? Okay. All right. I will. So, so a reminder: if you are trading the FOMC rate decision tonight or later on in the afternoon, Again, we'll be doing that prep there at 1 p.m. Eastern time. Remember, what I'll be doing for those who are not subscribed to the mailing list is I'll put in, is at the end of the day, I'll be sending out the recordings of the US retail sales and CPI, Canadian inflation data, the EIA inventories report, and then for the FMC, once we've done that, then I'll be putting that out tonight. So I'll do one email for 3 recordings, otherwise it would be a bit too much if I was to email you 3 times. But after the FMC rate decision, then I'll be putting that out for you guys to have a watch, and be prepared for tomorrow's release as well. So a reminder with tomorrow, what else do we have? So we've got the Bank of England rate decision at 7 a.m. Eastern time. So we're going to be coming in a bit earlier for that on our side. But thank you very much. Thank you for the fist bump, Wellington Prado. Thank you very much. I hope you found it useful. I will catch you guys next time.